So in this video we are going to discuss prepaid expenses and unearned revenue. So let's take a look here at this example. Brandy Company pays Harris Company $1,200 for 1 year of landscaping service. Brandy Company is gonna make that payment on January 1st, 2015. And so that's $100 for each month of upcoming service. So what we have here is a situation where we're going to look at it from both sides of the fence. So from Brandy Company's perspective, she's going to have an asset. It's a prepaid expense because what she's going to have is she's going to be paying for in advance for Harris Company to perform landscaping services. So let's take a look at what the entry is going to look like. Okay, so we can see here we have an increase to this asset here, prepaid landscaping service or prepaid landscaping expense. That's an asset because we've paid for it in advance and we haven't used it yet. So Harris Company owes Brandy Company landscaping services. So from Harris Company's perspective, now remember, Brandy Company wouldn't know exactly what journal entries are being recorded by Harris Company, but we're looking at it from both sides of the fence. So one person's prepaid expense is going to be another person's unearned revenue. So let's take a look at what an entry might look like from the perspective of Harris Company. So from Harris Company's perspective, they have received $1,200 and they haven't done anything yet. That's why this is a liability, unearned revenue. We've received payment, but we have yet to perform our service. So we owe Brandy Company something, and what we owed Brandy Company is the performance of the service. Another way to think about it is if we didn't do the landscaping, then we would need to give the money back, right? So this is the entry that would originally take place when the cash exchanges hands. Now remember, under accrual-based accounting, we don't record revenues or expenses until they are incurred. There's been no revenue earned by Harris Company at this point, and on the other side of the fence over here, under Brandy Company, there has been no expense that has been incurred at this point, only the exchange of cash. So now let's pretend on 1/31/15 Harris Company comes on out and does the landscaping that they had promised that they were going to do for Brandy Company. So at this point, Brandy Company is going to actually have landscaping expense, and this is going to be recorded. And prepaid landscaping, I'm just going to copy and paste this. Prepaid landscaping service is actually going to go down, and we said it was $100 a month. So it's going down by $100. So we are now recording the expense and showing the reduction in that landscaping service, which is the asset, so the prepaid expense. So let's go down here and look at this T account. So let's say we have prepaid landscaping expense. Up here from this first entry, we would have debited it by $1,200, and now here we've just used $100 of it up, right? So every single month for 12 months, we're going to continue to use this up. And then after 12 months is up, we're going to have a balance of 0. See, so each month that goes by, Harris Company is going to come out, perform the services, and we can see when we get down here to the bottom, we would have a balance of 0. We had this, we originally recorded it, and then now it's been whittled down, $100 each month, and now the balance is 0. Let's take a look from Harris Company's perspective what they would, and for each one of these 100s here, we would have another journal entry. So for example, then the next month when it came along, it would be maybe 2, 28, 15, and then the same for March and all the way throughout the year. Let's take a look at from Harris Company, the landscaping companies, from their perspective. I'm just going to copy the dates over here, and let's widen that just a tad. And so let me make this so where it can fit on the screen a little bit better. Okay, so from Harris Company's perspective, we're going to reduce this liability with a debit, and we are going to increase our revenue from landscaping by $100 every month. This is recorded after Harris Company has gone out and performed the service. So from Harris Company's perspective, let's create a T account and see what that would look like. So down here, when we originally took the cash but didn't perform the work, we're going to be plugging this into this T account here. And of course, there would be another T account for cash, and we would have debited it by $1,200 for this entry here. But the focus in this video is on the unearned revenue and the prepaid. So from Harris Company's perspective, the $1,200 here, and then with this month, we would have just reduced our liability with a debit. And then come February, if we went back out and did another month's work, we put another 100 here. We're making it so at this point right now our balance of our liability is 1,000. And if we came back out and did another month, we'd drop it by another 100. Okay, then we'd be at $900 for our liability. And eventually, when we get down to the end here, after all 12, the debits and the credits will be equal. We'll have a balance of 0 for that liability, and we will have fully earned it at that point. So once again, remember, these companies don't have access to the other company's accounting records. The purpose of this was just to show you the dual nature of the company that is receiving the services and the company that's providing the services. And a lot of times companies will find themselves in a place where sometimes they have prepaid expenses and unearned revenues as well. So one company might find itself on both sides of the fences for different transactions. Please let me know if you have any questions.